Welcome into the Organized Investor Show, brought to you by Tennessee Wealth Management, right here on your radio dial, 98.7 News Talk, 98.7. Guys, numbers don't lie. The numbers. It's me, Ainge, former NFL and UT quarterback, and I'm fired up to be with you guys today. With me, as always, the team, East Tennessee's Financial Foursome. That's us giving you your financial forecast. I can keep going all day. It's me, my wife, Susan, Jerry Goodman, Megan Hubbard. Jerry, a financial strategist who's been helping families organize their finances for decades. Like I said, my beautiful wife, Susan, currently studying for her Series 7 securities exam. Never hanging out with me anymore, but that's fine. Always doing that. And of course, Megan Hubbard, Jerry's daughter, and a key part of the team. Today, guys, we're talking about something that might change the way you think about retirement. Your advisor and your money. We are calling this one, How Much Do You Really Need? And is your advisor telling the truth? I think some of these numbers are going to surprise you, and I think some of them are going to make you want to pick up the phone. Well, that's the goal anyway.
Let me kick things off with some numbers that really matter. For calendar year 2025, the average client return for our group was 36.3% net of all fees and costs. The Dow Jones Industrial Average was up 13% during that same period. That is a difference of over 23 percentage points, and this is not a one-year fluke. Over 3 years, the average annual rate has been 19.3% compared to 13.2% for the Dow. Over 5 years, 13.3% versus 9.4% for the Dow. And over 7 years, 16.7% annually versus 10.1% for the Dow. Those numbers are posted on theorganizedinvestor.com for anyone to verify, with roughly 198 individual client accounts listed alongside the last 4 digits of each account number. Obviously, past performance doesn't guarantee future results, and investment results will vary depending on the investment objective and risk tolerance for each investor.
And those numbers are net of all kind of fees or costs, which is really important because a lot of firms will quote performance before the fees, and that could be a completely different number. The way we think about it comes down to what we call the 2% improvement. If we can improve someone's investment results by, say, just 2% a year, that's equivalent to, say, $20,000 annually on $1 million portfolio. And over 20 years, that's $485,000 of additional wealth when you compound that out. So we accomplish this with three specific things, doing it this way. First, lower advisory fees than what you're going to typically pay at a large wirehouse firm, which roughly is about 1/4 point less, which adds up significantly over time. Second, we avoid mutual funds and ETFs, all which come loaded with a lot of hidden internal costs. And third, we focus on selective stock investing in quality individual companies rather than owning thousands of companies through a packaged product of mutual funds.
And Jerry, that third point is huge. It's huge. Because it gets at what they call diversification.
Dun, dun.
And everybody freaks out. Most advisors put your money into 15 or 20 mutual funds, and each of those funds holds hundreds or even thousands of companies. So you end up owning a tiny sliver of everything, including a whole lot of companies that are dragging your performance down. If you had a football roster, instead of handpicking and selecting the best ones, right? DSIP list, right? Blue chip stocks. You just have everybody. Like, who wants that? And sure, you'll have those All-Americans on the roster. Well, you also have a bunch of guys that couldn't make practice squad or tie their shoes. And there are some stocks out there that can't tie their shoes. Your team's overall record is going to suffer because the stars are carrying all the dead weight that's dragging it down. That's exactly what happens with diversification. Then it leads to what they call diversified performance. Nice try, Jerry.
Do my best.
So, instead of owning thousands of companies through mutual funds, our approach here focuses on individual dividend growth stocks. Companies like Costco, Walmart, Home Depot, Lowe's, and Jerry's favorite, Smuckers.
Yes.
Smuckers.
These are not speculative bets on the next hot technology stock. These are companies that have been paying and increasing their dividends for decades. Lowe's, for example, they've increased its dividend for over 60 consecutive years through recessions, wars, pandemics, and every kind of market disruption you can even imagine. The Wells Fargo Diversified Stock Income Plan list, which we call the DSIP list, has averaged about 12% annually over 30 years.
And the second major strategy is taking advantage of bargain opportunities when the market overreacts. During COVID in 2020, the team bought hotels, restaurants, airlines, and cruise lines when everyone else was panicking. They spread the risk across dozens of companies, about 1% of the portfolio in each, knowing that as long as there were not mass bankruptcies, the strategy would be very profitable. During the regional banking crisis in 2023, they did the same thing. And during the tariff scare in the spring of 2025, they made over 12,500 trades in a single day. That's not a typo. 12,500 trades, swooping in on quality companies that were temporarily on sale. That kind of flexibility is simply impossible when you are locked inside mutual funds, and it's a major reason the 2025 return was 36.3%.
All right, now here's where it gets really interesting. And this is the part of the show I've been looking forward to all week, honestly. You've probably heard the financial media say you need $1.2 million to retire. That number comes from the Bureau of Labor Statistics, which says younger retirees between 65 and 74 spend about $4,870 a month. Round that up to $5,000 a month. That's $60,000 a year. Multiply that by 20 years, you get $1.2 million. Sounds terrifying, right? But here's what they conveniently leave out of that calculation. The average Social Security benefit for a couple is roughly $60,000 a year, which means Social Security alone covers most of your baseline spending. You do not need a calculator or a calculus degree to realize that you are getting $60,000 in Social Security and spending $60,000 a year. You're probably doing it all right.
And Erik is exactly right with that. When you run the actual math, the numbers that most people need beyond Social Security is dramatically lower than what the media wants you to think. If a company needs an extra $2,000 a month beyond Social Security, that's $24,000 a year. At a conservative 5% return, you only need about $350,000 to fund that gap, for the next 25 years of retirement. People come and see us and they'll have $500,000, $700,000, maybe even $1 million, and they feel like a failure because the media's told them they need $1.2 million. The truth is, those are inflated numbers, and they exist because the bigger your account looks, the more the industry can charge you in fees that you never even see. The financial media has created a culture of fear. That's all that this really is. Every commercial you see has some green line, the old Fidelity, where the magic number is there, and then you have some anxiety when it never looks good enough for your situation. People walk around saying, I just don't know if $1 million is enough. I don't know if $2 million is enough. And the industry loves it that way.
And here's something else people do not realize. The media's retirement number assumes you have zero income, zero Social Security, zero pension, and you are funding every single dollar of spending from savings alone. And guys, that is just not how it works for the vast majority of retirees. Most couples we sit down with are pleasantly surprised when they actually see the math because no one has ever shown it to them this way before. They have been so conditioned by the fear that they have never stopped to do the simple arithmetic. And there is actually a study from Northwestern Mutual that found people who work with a comprehensive financial advisor retire at age 64, while those who do not retire at age 66. Combined with the number one regret of people in their 80s, which is, I should have retired earlier, you start to see how the fear narrative is literally costing people real years of their life.
No, Susan, that's so important because it's not just about the money. It's about the time. Every year you work past when you could have retired because you were scared of some inflated number from a TV commercial, that is a year you don't get back. That's a year of fishing trips you missed, high school football games for your grandkids, vacations you put off. My playing days, we used to say the window does not stay open forever, and that applies to retirement too. The healthiest, most active years of your retirement are the early ones. And if you spend those years working because the media has scared you or you didn't call us, well, that's a genuine tragedy.
And speaking of getting the real numbers for your specific situation, we want to invite every one of you listening to our free monthly Organized Investor Workshop. It is held each month at 6 o'clock in the evening at Chesapeake's Restaurant on Parkside Drive right here in Knoxville. There is no cost to attend, but seating is limited, so reservations are required. You can reserve your spot by visiting the workshops page at theorganizedinvestor.com or by calling 865-415-2058. You will receive a 60-page workbook, a delicious meal, maybe some adult beverages, a full explanation about how to get a complete package of estate planning documents from Trust and Will, all without cost or obligation. And one lucky person's going to win a full-size Tennessee football autographed by Erik Ainge himself. The hosts of the workshop are Erik and Susan Ainge, myself, and my husband, Jared Hubbard, and then my dad, Jerry Goodman, also along with Amber DeLong, our operations manager.
So let us shift our gears and we'll talk about something that's going to basically open up some eyes here. Most people have no idea what they're actually paying inside of their investments, and the industry kind of likes it that way. You see, beyond whatever the advisor charges you directly, there's all these layers of hidden costs that are buried inside of mutual funds, exchange-traded funds, even annuities, that quietly just exit your account and every single year and you don't even see it. The internal management fees, trading costs, expense ratios, the list goes on. And here's the kicker. These costs never show up on a separate bill. They're just silently deducted from your account before you ever see them on your statement. It's like going to a restaurant where they add on a service fee, a kitchen fee, a plate surcharge, but none of it appears on the check because they just inflate the price of everything on the menu. You know, you'd be furious if you actually found out what the financial world's doing here, and this happens every single day, and no one seems to bat an eye.
There's just something about this industry that drives me absolutely crazy. If you go to the grocery store and the price of a loaf of bread goes up 50 cents, you notice it immediately. I mean, we compare two brands of paper towels just to save $1. But when it comes to one of the single biggest assets you will ever have, your retirement savings, most people have never once asked their advisor, how much does this actually cost me in real dollars?
You would not hire a roofer without getting a quote, right? And you certainly would not walk into a restaurant and, say, just bring me whatever and charge me whatever you want. But that is exactly what millions of Americans are doing with their life savings, and the industry has designed it that way on purpose. The fees are hidden, they're buried in fine print, and they are expressed in percentages specifically so you never convert them to actual dollars.
Megan's onto it right there, and this is the thing that kills me. You spend 10 minutes in the cereal aisle comparing $4 box of Cheerios to the $3 store brand, but you've never once asked to see exactly what's being taken out of your investments each year. You shop 3 different websites to save $40 on a plane ticket to Orlando or wherever, but you have no idea what your mutual funds are charging you in hidden internal costs. And the reason is simple. The investment industry has made those costs intentionally invisible. They're embedded. They're netted off your returns, and they're expressed in tiny percentages so you never think about what they actually add up to over 10, 20, 30 years.
And the embedded costs inside of those mutual funds are the part that almost nobody knows about, okay? You know what the advisor may be charging you because maybe they told you that, but you don't know what the funds themselves are charging on top of that are buried underneath. Most people do not know that simply because the internal costs are, again, as Erik mentioned, quietly being netted off the gains before you ever see it on your return. When you get your statement, you look at the total at the bottom, and the internal expenses have already been taken away, and they're nowhere to be found. You wouldn't accept that from any other kind of business in your life. If your cable company was tacking on some hidden fee that never appeared on your bill, you'd be on the phone in about 3 minutes demanding some sort of an explanation about where did this happen. So the investment industry, they've been doing this for decades, and because you never see a separate line item, you're never going to question it. It's not just oversight, folks. This is by design.
And that is exactly why the 4 get 1 frees are so important, because they shine a light on what you are actually paying and what you should be getting. So first, we'll pull your Morningstar report and give you a plain English breakdown of exactly what you own, what you're paying, and how your investments have actually performed. Second, you'll get a complete cash flow analysis that shows you what retirement actually looks like with your specific numbers, not the scary ones from television. Third, through our partnership with Trust and Will, you can get a full package of estate planning documents, including wills, trust, power of attorney, and healthcare directives, all completely free. And fourth, just for fun, we're giving away signed Tennessee footballs because life should not just be all about spreadsheets and tax returns.
It should be about football.
To take advantage of any of those, you can visit us at theorganizedinvestor.com or call us at 865-415-2070, which rings straight to Jerry's phone. Lucky him.
Lucky me.
He'll have to hang up on me.
Yep.
But he's happy to talk to you for what he calls Ask Me Anything in 20 Minutes chat or longer.
And I want to add one more thing about why this matters so much in real dollars. There's an example on our website of a typical mutual fund advisory account that shows the average internal cost buried inside those funds, and it's 0.79% annually. Now, 0.79% doesn't really sound like much, and that's exactly why they express it that way. But $1 million in your portfolio is going to equal $7,900 quietly disappearing every single year out of your portfolio because of that 0.79%. And most people have absolutely no idea it's even happening. You would lose your mind if your electric company was overcharging you $7,900 a year and hiding it in your bill, right? I certainly would. You would call the news. You would call a lawyer. You would switch providers that afternoon. But because this cost is invisible and expressed as a fraction of a percent, people just shrug and never really question it. Over 20 years, those hidden costs, they add up to to a staggering amount of money that should have stayed in your pocket and funded your retirement.
Oh, and by the way, if anyone questions our performance numbers, just remember this. We post the returns for 198 accounts right next to the last 4 digits of each client's account number on the website. Our clients, they can look and, boom, there's my number right there, and verify exactly what their return was. If those returns weren't accurate, we certainly would not be putting them on a website where our own clients can check them. They're there, they're real. I know that this is abnormal. No one else is doing this. We do. When we get back, we're going to talk about the 3 signs that you've outgrown your financial advisor and what you can do about it. Stay right here. It's the Organized Investor Show, brought to you by Tennessee Wealth Management on News Talk 98.7.
Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner Trust and Will. Our next workshop is Tuesday, March 24th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend. However, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
Welcome back to the Organized Investor Show, brought to you by Tennessee Wealth Management. It's me, Erik Ainge, alongside my wife, Susan Ainge, Jerry Goodman, and Megan Hubbard, all part of the team here at Tennessee Wealth Management. Before the break, we showed you that the average client return for 2025 for us, 36.3% net of all fees versus the Dow at 13%, with consistency stretching back 7 years. Past performance doesn't guarantee future results, and investment results will vary depending on the investment objective and risk tolerance for each investor. Yes, have to say that. We showed you that the $1.2 million retirement number the media throws around is inflated because it ignores Social Security, and the real gap for most couples might be as low as $2,000 a month. And we started pulling back the curtain on the hidden costs buried inside people's investments. Now we're going to dig into whether your current advisor is actually working for you or working for themselves.
Here's a statistic that blew me away when I first heard it. According to Morningstar, only 6% of people ever leave their financial advisor. 6%, which means 94 out of 100 people stick with the same advisor no matter what happens. And it's not because the service is amazing. It's because of social bonds. They go to the same church, the same Kiwanis club. They live in the same neighborhood. Maybe they go to the same, country club. I don't know. Whatever it might be, they work out at the same gym. There's a bond there. Your advisor, I'm sure, is a nice person. They probably send you Christmas cards. They ask about your grandkids. But nice and competent are 2 very different things, and too many people confuse those 2 things. So here are 3 signs that you may have outgrown your financial advisor. And I would encourage every single person listening to be honest with yourself about these 3 things.
Sign number 1 is your advisor has not addressed your actual retirement goals. If nothing's ever changed in your financial plan from the moment you were actually working to the moment you're retired, that's a big red flag, isn't it? Your life changed completely when you retired. You went from accumulating money you're going to need to support you during the rest of your life. But if your advisor's approach didn't change at all, if you're still in the same funds, the same allocations, the same strategy, then basically your plan never transitioned.
And to add to that, when you think about what retirement actually looks like day to day, it is a completely different financial world than what you experienced when you were working. When you were working, you had a paycheck coming in every 2 weeks. You were filling up your 401k. And if the market dropped, you just kept buying at lower prices. But in retirement, you are pulling money out. And if the market drops 30% in your first year of retirement, that is 5 or 6 years of savings gone in 6 months. That is the difference between climbing the mountain and coming back down. For example, on Mount Everest, 3 times as many people die going down as going up. And the same danger ratio applies to retirement planning. The skills and the strategy that got you up the mountain are simply not the same skills and strategy that you need to get down safely.
No, you're right, babe. And it's like in football, because this is what I do. You don't just close your eyes and call a play and run the same play and then call the same play and then run the same play. In football, you don't do that, right? Especially when the score situationally it's changed. The game plan, it has to evolve. When you're working and saving, that was the first half. You were on offense, moving the ball down the field, getting yards, trying to get points. But in retirement, in the fourth quarter with a lead, you're in 4-minute drill. You need a completely different strategy. You need to protect the lead, manage the clock, and make sure that you do not give it all back with a costly turnover. If your coach is still calling the same plays from the first quarter, it might be time for a new coaching staff.
So sign number 1 is that, they don't change things when you retire. Sign number 2 is that your advisor has not addressed your 401k and IRA tax liabilities. Your IRA or 401k is the largest liability on your retirement balance sheet, and it's not even close. Your house and your cars may be paid off, but $1 million IRA could carry up to a $400,000 tax liability. If your advisor says just wait until 73, that is Uncle Sam's plan, not yours. Uncle Sam is not in the business of wanting less money in your taxes. The client is literally the only one who does not benefit from the wait and see approach. And when you think about it that way, it does not pass the smell test.
Sign number 3 is you're probably paying too much. Most people have no idea what they're actually paying in total. When you add up the advisory fee plus the internal investment costs on some of these mutual funds that are probably in your account, the total might be 2.5%. So on a $2 million portfolio over a 30-year retirement, that's $600,000 gone in fees. $600,000, folks. That is real money. That is a vacation that you could have taken. Those are grandkids that you didn't help. That's memories that you never got to take because the money went for all these excessive fees. You will negotiate with a car dealer for 2 hours to save maybe $500 on a vehicle. But you've never once demanded to see a complete accounting of every dollar taken out of your retirement savings. And the reason most people don't have any kind of clue is because finding the fee on your statement is like trying to crack the Da Vinci Code. The statement's printed on double-sided, 47 pages long. Fees are buried somewhere deep, and you practically need a magnifying glass and a decoder ring just to find these things. And it's not by accident, folks. These are actually done by design.
And there is a story that captures what we are talking about here. A financial planner's daughter is an incredible soccer player. Just dominant on the field, but she decided to try basketball for the first time with her friends who had been playing together for 3 or 4 years. In her very first game, in one 6-minute quarter, she had 7 steals, 6 rebounds, and 8 missed layups. 8 missed layups in a single quarter. And what'd she do? She looked up at her dad and she smiled.
And the point of the story is perfect for this conversation. Raw talent without the right coaching, well, it gets you so far. And that applies to your money as well. Your portfolio might be hustling and making some great plays, but if you're missing all the layups on tax planning, fee management, retirement income strategy, you're leaving hundreds of thousands of dollars on the court. There's your missed layups. And if you're paying $12,000 or more a year in advisory fees, here's the question you really need to ask. What exactly is that $12,000 going to? What's it getting you? If the answer is nothing more than your money sitting in some mutual funds, well, you're getting ripped off.
For that kind of money, you should be getting comprehensive services, tax planning, estate planning, retirement income projections, and an actual strategy tailored to your situation, not just a quarterly statement and a pat on the back. You deserve more than a nice lunch twice a year and a Christmas card. You deserve someone who is fighting for your future every single day.
Folks, if any of this is resonating with you, I want you to make sure you know about, again, our free monthly investor workshop at Chesapeake's Restaurant, Parkside Drive, 6 o'clock each month. The hosts are myself, Susan, Megan, Jared, and Mr. Ainge behind the microphone here, along with Amber DeLong, our operations manager. You're going to get a wonderful 60-page workbook, fabulous meal, great conversation, possibly some adult beverages, and you're going to learn how to actually organize your financial life. We're going to walk you through how estate planning documents through our partner, Trust and Will, is absolutely no cost. And one person is even going to win a signed Tennessee football by Mr. Ainge.
And some high fives.
So reserve the spot at theorganizedinvestor.com on the, I think it's the workshop page, or give us a call, 865-415-2058 to reserve a seat because the seats are limited.
One of the things I've learned studying for the Series 7 is just how far the incentive problem actually goes. There is a dirty, dark secret in IRA planning that most people never hear about. Most advisors know that they're going to be retired themselves before they have to deal with the fallout of not planning your IRA distributions properly. The real pain is not felt for 20 or 30 years, and by then, your advisor has long since collected their fees and moved on.
Meanwhile, your kids inherit that IRA during their highest earning years and get hit with tax rates of 30, 35, even 40%. And here's a real example that makes my blood boil. A woman inherited $680,000 from her parents who had both recently passed away. The advisor managing that inherited money was charging a 1.75% fee, which is nearly $12,000 a year, for likely doing nothing more than putting her money in mutual funds with additional internal fees on top of it.
That story is heartbreaking, and it happens way more than people think. People who inherit money are especially vulnerable because they didn't earn that money themselves, and they may not fully understand it. And they are emotionally vulnerable from the loss of their parents. And too often, they just keep the advisor their parents used out of loyalty or inertia without ever questioning whether that person is actually earning the fee. You would not keep your parents' doctor if they were not taking care of you properly, right? Why would you keep their financial advisor if you have never asked to see the results?
And here's what ties it all together and really gets to the heart of the conflict here. If you spend your money, your advisor takes a pay cut. Think about this, okay? When they're charging, let's say 1% or maybe 1.5%, and you take out $100,000, for a trip to Europe or maybe to help your grandkids with college, that actually is an annual fee that just went down for them. And if they scare you enough, you're not going to touch your own money. And they get to keep making that same amount on the account year after year. The key to retirement is not funding or trying to build your financial advisor's retirement plan. It's about building your own. And when people focus on what they actually need versus what the industry wants them to fear and be concerned about, they're pleasantly surprised and could probably retire a whole lot earlier than what they really think.
And I want to add something here about what a comprehensive plan actually looks like when it is done right. It's not just about picking the right stocks or avoiding the wrong fees. A real retirement plan includes a detailed, year-by-year strategy that shows you exactly when and how much to pull from your IRA each year, so that way you're paying 10 or 12% instead of 30 or 40. It includes estate planning documents to make sure your spouse is never locked out of your own money. It includes a long-term care strategy because nursing home costs regularly exceed $100,000 a year. And it includes what we call spending empowerment, which is giving you the confidence and the permission to actually enjoy what you have built. If your current advisor is not addressing all of those areas, then the $12,000 you are paying them every year, well, it's not buying you very much.
All right, Susan's absolutely right. And that comprehensive approach is exactly why the results look the way they do. When you put all the pieces together, the investments, the tax planning, the estate documents, the fee savings, it creates a multiplying effect. Each piece makes the other pieces work better. It's like that football team where the offensive line protects the quarterback. The quarterback delivers an accurate pass. The receiver, he catches the ball after running a good route. And give him 6, everybody scores. Each position makes the others better. And that's how we go from average to elite. That is the difference between a 13% and a 36.3% year.
And if anyone is skeptical about the numbers we share, let me address that directly. We post the performance of roughly 190 accounts on theorganizedinvestor.com with the last 4 digits of each client's account number right next to their return. Our clients can look at that list and find their own account number and verify exactly what their performance was. We don't share full account numbers, and we certainly do not show names. But if those returns were not accurate, would we be putting them on a public website where every single one of our clients can check them? That level of transparency is rare in this business, and there's a very good reason for that.
And I think what makes this whole conversation so important is most people have never been given permission to question their advisor. The industry set it up so question your advisor may seem kind of disloyal. You're being ungrateful for them helping you. But guess what, folks? You're paying them. But asking your advisor to show you their track record is not disloyal. It's basically being responsible. Ask what you're paying in total fees. Asking that is not rude. It's common sense.
I mean, you would not let a mechanic start working on your car without asking what it's going to cost you, right? So why would you let someone manage your life savings without asking them the same question? And asking whether your plan has actually changed since you retired, it's not being difficult, it's being smart. Those are the same questions you would ask a contractor before they remodel your kitchen. Your retirement is worth a lot more than a kitchen remodel, by the way.
And that's exactly why the 4 get 1 frees matter so much. That Morningstar report, cash flow analysis, the estate planning documents from Trust and Will, your son football, all free, all at theorganizedinvestor.com. Go call Jerry, 865-415-2070. And here's, I like to think about it quarterback-wise. The quarterback that throws for 300 yards but turns the ball over 3 times still loses the game. An advisor who grows your account on paper but lets 40% disappear to taxes and fees, it's the same thing. Impressive stats on the surface, terrible outcome when it actually all boils down, right? When we come back, we're going to talk about what it actually looks like when your advisor's completely and totally on your side. Trust me, the difference is night and day. Don't go anywhere. It's the Organized Investor Show, brought to you by Tennessee Wealth Management, right here on News Talk 98.7.
If you're interested in a more personal learning experience, join us at the Organized Investor Workshops. Erik, Ainge, and the entire team will be there. The next event is scheduled for Tuesday, March 24th, 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. Attendees will receive a 60-page workbook, a yummy meal, and learn how to get free estate planning documents through our partner Trust and Will. Seating is limited, so reserve your spot at theorganizedinvestor.com or call 865-415-2058. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
Welcome back to the Organized Investor Show, final segment of this show. It's the Organized Investor Show brought to you by Tennessee Wealth Management. It's me, Ainge, here with Susan Ainge, here with Jerry Goodman and Megan Hubbard. Quick recap for anyone just joining us. We've been talking about the real retirement numbers versus the inflated ones the media pushes, the 3 signs you've outgrown your financial advisor, and the hidden costs buried inside most people's investments. Our average client return for 2025 was 36.3% net of fees versus the Dow at just 13%. You can verify those numbers right there at theorganizedinvestor.com. Obviously, past performance doesn't guarantee future results, and investment results will vary depending on the investment objective and risk tolerance of each investor.
So how do you actually know if your advisor is working on your behalf and not just going through the motions? Here are some things to look for. First, are they proactive or reactive? Meaning, do they come to you with ideas and strategies, or do they only call you when you call them? Second, have they built you a customized plan that addresses taxes, estate planning, long-term care, and spending? Or are you in the same cookie-cutter portfolio as every other client they have? Third, do they encourage you to enjoy your retirement? Or is every conversation about what could go wrong and why you need to be careful? And fourth, can they show you their results? Not just a glossy brochure or, hypothetical returns, but actual client performance that you can verify with your own eyes. If your advisor can't check all 4 of those boxes, that tells you a lot about whose interests are really being served.
And Megan, I've seen the difference that kind of advisor makes firsthand sitting across a table from various families. When a couple comes in and we actually show them the cash flow analysis and they realize that they could have taken an anniversary trip to Italy or maybe helped their daughter or make a down payment on a house or any number of other things, you can see the look on their face. We had a gentleman come in recently. He basically was told by his prior advisor that for years he needed to be careful. The market could crash. He shouldn't touch any of this money. And when we showed him the actual math on this, we showed him that his Social Security was covering the majority of his expenses and his savings were really kind of more just there as kind of extra money. He really was just literally shocked. He said, I've been worried about this for years and for no reason.
And here's the fundamental truth that the financial industry does not want you to understand. The market is what gives you your returns, not your financial advisor. No individual advisor has a crystal ball, and over meaningful time periods, almost no one consistently beats the market net of fees. The real value is in keeping your money, making sure Uncle Sam does not take more than his fair share through smart tax planning, making sure the market does not wipe you out when it dips because you have too much risk in your portfolio, making sure you are not hemorrhaging money in unnecessary fees. And lastly, making sure you have a plan if long-term care costs show up down the road.
And that planning is exactly what the DSIP dividend growth strategy is built around. Those individual stocks, companies like Costco, Lowe's, Walmart, you hear us talking about them. It's not about chasing the highest return. They're about building a reliable income stream of growing dividends that you can count on through good markets and bad. When you combine that investment approach with tax planning, estate planning documents, and spending empowerment, well, now you have a complete retirement plan. If you're only talking about investments with your advisor, you're missing most of what matters. A study came out, a study from Northwestern Mutual, that found that people that work with a comprehensive financial advisor retire earlier. They retire at 64. Those that don't retire at age 66. And the number one regret of people in their 80s is, I should have retired earlier. Having the right plan gives you the confidence to actually pull the trigger when the time is right.
Erik, you said something that really hit me: spending empowerment. The financial industry has been built on a chassis of investment advice, not dream advice. 90% of the industry is telling you all the things you cannot do or the things that you should not do. What you really want is someone who's going to find you the yes, not take you straight to the no. And part of what we want to discuss when we meet people is what is actually possible in your retirement so you can get excited about it.
And that excitement is exactly what we see at our free monthly Organized Investor Workshop. It is at Chesapeake's Restaurant on Parkside Drive right here in Knoxville, 6 o'clock each month. You get a 60-page workbook, a wonderful meal, maybe some adult beverages, and most importantly, a real conversation about your financial future.
And good company, right, guys? We're pretty cool.
Maybe.
One lucky attendee wins a full-size Tennessee football signed by my husband, Erik Ainge. The hosts are Erik and myself, Megan and Jared Hubbard, Jerry Goodman, and Amber DeLong. So go ahead and reserve your spot at the workshops page on theorganizedinvestor.com or call us at 865-415-2058. Seating is limited, and these do fill up, so go ahead and reserve your spot.
Come hang out.
Love to have you. So let me share a story with you that captures what retirement really should feel like, okay? We have a friend who likes to, we will say, and we all have a person like this, likes to live life to the fullest. So he goes on this business trip to Mexico City, kind of like a wild place, with some colleagues and their spouses. So one evening they go to this, what's called, if I'm saying this correctly, Lucha Libre wrestling event. Basically, it's like Mexican professional wrestling with colorful masks, capes. Sound like something you'd hang out in, Erik. With a whole lot of energy, which is you, Erik, again. So before the main event, the wrestlers are out there and they're trying to get the audience all riled up. They want to get them in the ring. I've never been to something like this. So anyway, I figured out my friend's wife looks at him, points her finger and said, do not dare go down there. Okay, you stay right there. Basically not keeping that in mind, he had a herniated disc in his back. He had no business going down there. But what does he do? He peels off his shirt.
Let's go.
Goes down, hits the ring in apparently traditional fashion, jumps in there, and he's running around slapping his chest with all these professional guys. Now, for the next week, his back was all banged up, but he said it was absolutely worth it. He remembered it for the rest of his life. And isn't that the whole point of basically what we're talking about today? Retirement should be something that you say yes to in terms of life, okay? Not sitting on the sidelines because your advisor scared you into thinking that you can't afford to do something fun like that.
That's why they say YOLO, Jerry. You only live once. And I love that story because it reminds me of something we see all the time. People, they come in for their first meeting and they are tight. They're anxious. They've been told by their advisor for so long that they've forgotten what it actually feels like to dream about retirement. They've been living from one S&P update to the next, stressed out about every market dip, checking their phone every morning to see if they're still okay. That sounds awful. You've been stressed and working for 30 years, and now you're going to be stressed in retirement, watching your investments every single day. That does not sound like a plan. That sounds like a prison. $1 million is a ton of money, and it does not require a team of people and a daily anxiety attack to manage. It should be on autopilot, predictable with decent returns and a plan that addresses the biggest risks.
And that is exactly the shift we see when people come in for a discussion. They walk in nervous and guarded, and they leave with a completely different look on their face. Because for the first time, someone is showing them what they can do, not what they cannot do. Someone is dreaming with them instead of scaring them. 90% of the financial industry is built on telling you no. You should not take that trip. No, you should not help your grandkids. No, you should not retire yet. We believe the person sitting next to you should actually be helping you do the things you want to do, not building a wall of fear between you and the life you've earned.
That story is perfect because it gets to the heart of the question everybody should really ask themselves. When you're on your deathbed, do you want to share a bunch of zeros on your bank statement, or do you really want to reflect back on some great memories? Break the piggy bank that you own, okay? And do it the smart way. Do it with a plan that coordinates your investments, your taxes, and even your estate planning documents all rolled up together.
The industry has created such a culture of fear where it's never good enough, never enough money, never enough savings. But when you actually run the math, when you see that Social Security covers much of your baseline spending and the real gap might be only $2,000 a month, the picture completely changes. And suddenly, you have permission to live the retirement you worked, 30 or 40 years to earn?
And here's one of the things that really drives it home for me. We sat across the table from people in their 70s, and they tell us that they wish they had done this 10 years ago. Well, they spent a decade being scared, a decade checking their portfolio every morning, a decade saying no to the trips and the experiences that could have been trips of a lifetime with family. Now they realized that all that worry was unnecessary because when someone finally ran the real numbers for them, their Morningstar report and the cash flow analysis, well, they realized they had more than enough. That's exactly what we do. We do not want people looking back with regret. We want them looking forward with excitement.
So the easiest first step you can take today is our 4 Get 1 Frees. A free Morningstar report with a plain English breakdown of what you own and what you are really paying. A free cash flow analysis that shows you what retirement looks like with your actual numbers. Free estate planning documents through Trust and Will, including wills, trusts, powers of attorney, and healthcare directives. And a signed Tennessee football from Erik, just for showing up. Visit theorganizedinvestor.com or call 865-415-2070, which rings directly to my dad's phone, where he'll do his best to actually answer it.
Folks, here's the bottom line for today. You may need a lot less money than what the media is telling you. And, you may be paying a lot more than you actually realize to your advisor in terms of fees because of the financial incentives, basically, and they're trying to keep you scared. The good news is you have options. Get your Morningstar report we keep talking about. Get your cash flow analysis. Get your estate planning documents. If you don't do anything else, please do that. And start asking some hard questions. Past performance is never guaranteed, but knowledge and a real plan are the 2 most powerful tools you can bring into retirement. It's been a pleasure talking to all of you today.
And I'd like to just add one more final thought. When I started studying for my Series 7, I thought the financial industry was mostly about picking good investments. Our team has an excellent track record. The more I learn, the more I realize that the real battle is not just about the returns. It's also about keeping the money you have already made, keeping it from excessive fees, keeping it from unnecessary taxes, keeping it from the market risks that you do not need to take. If your current advisor is not fighting that battle for you, well, maybe it is time to find one who will.
I know a place. All right, guys, thanks for joining us today. It's the Organized Investor Show. Remember the website, guys, theorganizedinvestor.com. Remember the number. That goes straight to Jerry, 865-415-2070. Come see us at one of our workshops at Chesapeake's. Bring your spouse, bring your questions, and let us show you what's possible. The best teams I ever played on had one thing in common. Everyone in the building was pulling in the same direction. When your advisor's incentives are aligned with yours, when they are truly on the same team, well, that's when you can start winning. That's the kind of relationship you deserve. And again, I know a place you can go, theorganizedinvestor.com. It can change everything. Until next time, this is Erik Ainge saying take care of the people that you love. Take care of the money that you've earned. We'll see you next week right here on the Organized Investor Show, brought to you by Tennessee Wealth Management on Newstalk 98.7.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or Tennessee Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management in Knoxville and Prospera Financial Services in Dallas, Texas. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. Brokerage and advisory services are provided by Tennessee Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by Tennessee Wealth Management for educational platform purposes. Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner Trust and Will. Our next workshop is Tuesday, March 24th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend. However, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058.